Hi everyone, hope you're all doing well. Today we're going to talk about the 5 stocks to buy in July 2022. I'm going to go through these 5 companies and talk about why I'm buying them in the month of July. I know I normally do 3 stocks, but at the moment I think the UK market is just getting dragged down with a lot of things that are going on that I'm sure many of you guys that are watching this video are aware of. So yeah, with the UK market really starting to tank a little bit, I'm taking that opportunity of kind of where I'm normally talking about 3 stocks, I'm going to have 5 stocks today, and I'll spend a minute or two on these companies and talk about why I'm buying them. So I hope you enjoyed the video. If you could, hit the like button, and as always, comment down below, let me know what UK stocks you're buying at the moment in this dip. Always like to hear you guys talk about some stocks because some of them could make my watch list and I could track them as well. But anyway, enough of that, we'll get stuck onto the video. And as always, if you want to know when I'm buying and selling these companies in real time, the place to be is on the Patreon. I post buy and sell alerts in real time, as well as that I do 2 exclusive videos a week on Patreon. So if you do want to join that, link is in the description. Starting off with number 1, Katebox. So this is a company that gives me a bit of, I think it will give me a bit of dividend. It'll give me a bit of share price appreciation as well. So it has very much a lot of growth in this company still, and also we've collected that growth. That dividend is going to be really nice as well. It trades down at 12 times earnings, which I think is very cheap for a company like this. It's kind of because of this valuation. This is why I would actually potentially be buying Greg's at the moment, but this valuation is a lot more attractive and the dividend yield is a lot higher, and potentially the growth is going to be a lot higher. That's actually why I'm actually picking up Katebox more than Greg's. Now at the moment, the share price basically since it came on the market has done nothing. Well, actually it's up 41%. That'd be a bit unfair to do, but it actually did have a little bit of a jump, as you can see here from its IPO. So if we actually take that IPO jump out of the way, it's actually only up 17% since it's been on the market. It's in like 4 years, which is just insane. It did start to get some respect after the CV situation. You can see here it went on an absolutely great run, and then unfortunately around this stock crash that we've been having, this stock has got punished absolutely huge for it. I mean, just look at that dip from the 31st of December to the 4th of March, 60%. And this is a company here that, in my opinion, has had such an unjustified dip for a company that's performing absolutely amazing, and I'm capitalizing on this dip at the moment. Now, if you don't know what they do egg-free cakes. They are, in my opinion, going to double, well, this is the target as well, but I think they're going to double the footprint in the next few years, so they're going to double up the stores, which is going to be great, as well as maximizing that online delivery. Obviously, the unique selling point is obviously that they do egg-free cakes, which obviously some people will enjoy, but as well as that, the quality of the cakes is obviously fantastic as well. And I know that a few people were worried because we're going into a bit of a potential slowdown or recession, and this could affect Katebox, but Katebox has already been through the 08 Great Recession, and I think they'll make it out okay through here. And people do kind of prioritize these sort of things. You know, people do not really want to cut expenses on birthdays and still make sure you have a good birthday cake. You know, it's one of those things that I think people still will prioritize in a recession, which is proven through the 08 dip as well. We talked about the valuation. I think valuation is just insanely cheap at 12 times earnings. You can see it compared to a few stocks here, and think it, like if you compare it to Greg's, I think that's like 16 times earnings. The growth has been phenomenal. If we start with the past performance, just look at the growth on the revenue, and you can see here the actual profit has been dragged up as well with it. If we go from 2018, since the IPO time, you can see here we were doing about 12 million in revenue, 2.7 million in profit, and now we're doing 6 million in profit and 32 million in revenue as well. So you can see this doesn't deserve that share price reflection. You know, I'm looking at the business here, and the business is absolutely doing amazing, and sooner or later that stock price will get that reflection, which is fantastic. Now the future growth, like I said, will come from opening more and more stores and hopefully dragging more online revenue, also potentially expanded into supermarkets. This is one thing they've been doing, is having stores in supermarkets as well, and that will get the revenue to increase at good rates going forward. There's only currently one analyst that is actually covering the stock at the moment, but I would expect Katebox's revenue to be somewhere around that 8-9% going forward, and I'd expect the profit to kind of tick in that direction as well, which would be really good amounts of profit growth, and that should also lead to some good share price appreciation and that dividend as well. Like I said, the dividend is around about 3.9%, which is good. It's quite well covered on a payout ratio as well, and as well as this company, it's a founder-led company as well, which is great. So if you can see here, we have a founder-led company where the founder actually owns 24% 4% in this stock, which is fantastic. One of the concerns was around an inventory issue a few months ago. That's why they ended up replacing the CFO. That all seems to be rectified right now. And I think a few people got the worry of like, oh, potentially they're getting the accounts wrong and the frauding numbers. Well, at the end of the day, if that was to be the situation, the person that would really suffer from that would be the CEO and founder, because they still own 25% of the wealth in this company, so they obviously don't want to be doing anything like that. So yeah, I think this company here, you've got a great valuation, you've got a 4% dividend yield, you've got a company that's growing at really good rates as well. So yeah, I think this could potentially, obviously in my opinion, this should be commanding a higher PE ratio because it's a higher quality company. I think this should be potentially around that 20 times earnings rate, as well as collecting that 3.9% dividend. You work out a 7-8% profit on revenue growth to be a little bit conservative on the company in the next 5 years. You've got a very good return and a very good dividend stock here. So I'm a big fan of that one. Next one is Airtel Africa. So I am buying Airtel Africa at last. I did buy some, and I bought some not this week, the week before. I've been on the fence about potentially buying this one. I've been in this stock for around about 2 years-ish right now. It's a stock that's performed absolutely amazing, as you can see here. I'm currently up around about 100% on this stock right now, which is absolutely fantastic. And it is a very good valuation. Whether or not you have to say, same again at 10 times earnings, I think they should be probably around 20 times earnings. Maybe because of the countries that it operates in, that puts it a little bit more of a political risk, and maybe that's why it trades down at a lower valuation. But it's still such a premium company. Same again, I think this is going to have a lot better, it's going to collect in a 2.7% dividend yield, but the growth is going to be fantastic on profit and revenue. So you're going to get some share price appreciation once again, but as well as that, you're also going to collect that lovely dividend as well. And I also think it's undervalued at 10 times earnings. Now, if you don't know what Airtel Africa does, they are telecommunications and mobile money. So basically they're like a PayPal in Africa. And in Africa, they don't really use that many like traditional banks. So this kind of covers the space by being a bit of a fintech company, a bit of a PayPal. So they basically have the telecoms, and a lot of the countries in Africa use a lot of voice messaging services. They use a lot of mobile data as well, rather than what we would traditionally use with Wi-Fi. And as well as that, like I said, they don't have too many banking systems or the traditional banking systems, and they are more towards like what Airtel Africa have with their PayPal version of their money side of it. So yeah, a very good growth sector here in multiple countries as well. And I've got to say that eventually, like, I've been doing an hour about buying more of this one, because I really do hate averaging up when I'm up over 100% on this company. But eventually I just got to the point of view of like, okay, it's flatlined. At the time it was having this kind of like little bit of a dip here, down 16%. And I thought, I'm just going to buy it. And listening to a podcast, which is called The Investor Way, first time I've heard someone else actually talk about this company. It's such a fantastic company, and I hear no one else talk about it. And it's the first time I've actually heard someone else talk about it, and they were saying exactly the same. Like, for a company that they were sound like they're in the same position where it's gone up on such a good run, and it is a bit hard to average up. But when you look at it and you go, it's at the same valuation where it was a year ago, even after all this run, because it's grown profit that much. You bought it at the same valuation last year, so why not buy it again this year? And I was like, that's actually so true. It's always good to kind of hear someone else's opinion on this situation, and hearing them say that it's the same valuation of where it was a year ago. Why would you not buy it? Don't get caught up in the stock price running up. And I was like, that's actually so true. And yeah, that's the combination, I guess, of really me buying it, and also they still carry on putting really good financial results out. Like I said, financial results are just absolutely amazing. Reported revenue grew 20%. Q4 was 19%, or if you go on a constant currency basis, 23%. The underlying EBITDA was up 29%. Operating profit was up 37%. Profit after tax grew 82%. It's just absolutely phenomenal results. And if we have a look here, you can see the growth in every single country here. Nigeria 27%, East Africa up 22%. And you can see here the revenue in voice was up 15%, which is probably one of the slower growing areas. The data is up 34%, which is fantastic, and the mobile money was up 34%. And this doesn't make a lot of the revenue up at the moment, but I think this is a really big part of the platform to be watching. I think this has a lot of potential to grow in the next few years, so that's what you want to really keep an eye on with this business. When we look at the company here, like I said, the valuation, I think at 10 times earnings is fantastic. I think they should be 20 times earnings. Whether or not the reason why it's been held down is we're in a bear market or just because it has a bit more geopolitical risk to it potentially. But when you look at the performance in the last few years, you can see the growth in revenue here, the growth in profit as well, which is fantastic. Financial health wise, the only concern I ever had with Airtel Africa was its financial health wise, but it's actually started to sort out its balance sheet now. As you can see, it's paying down debt, which is absolutely fantastic. So the only one concern that I had with it is being resolved, which is obviously another great combination that you have there. And like I said, according to Wall Street, it's currently 2.6% dividend yield that you're picking up, which is a lovely dividend. So yeah, big fan of Airtel Africa. Next up, Barrett Development. So this is a stock that I think I'll get some share price appreciation on. It doesn't grow as much as Airtel or Katebox. I think it will only grow, that kind of 3% a year, maybe 4% a year, which is absolutely fine. That will obviously keep the dividend going up in the right direction and also the share price slowly. But I do think at 7 times earnings it is a little bit cheaper. I don't think there should be one that's at 20 times earnings. I think there should be maybe around that 11-12 P ratio. So I think it is sold off a bit too much, but I don't think it'll be a company that trades as a premium as much as the other two. It is a house builder. I think there's a lot of good house builders out there at the moment that are on sale, whether you're a Persimmon, Redrow. I know a few of you guys are Taylor Wimpey. I'm a big fan of Taylor Wimpey. I choose Barrett Developments because they seem to be building a lot near me, which is always really good that I can just keep an eye on them slightly. As well as that, I also think that out of all the new house builders, obviously everyone knows that new houses can be lacking the quality. And I think that out of all of them, the one that has the more respect and the better build quality is Barrett Development, so that's why I do tend to stick with them. So yeah, 7 times earnings, 7.2% dividend yield at the moment. It is having a massive dip. You look here from the 4th of January 2022, it's down 40%. Now at the moment there is no effect on the housing market. The sales are still really strong. If we have a look here, prices are still going up. People keep saying they're going to fall, They've been saying that since the start of January 2021, when they said the stamp duty was going to get cut. They said that from 2021 house prices will slow, and what we've had since then 1.5 years of house prices and the housing market being as strong as ever. So this just shows you, don't listen to what analysts expect saying or anything like that. And what is priced in here is a massive collapse of the housing market or massive slowdown, and we're nowhere near that. Now, understandably, the reason why is that people are worried because we're entering a bit of a slowdown in the economy. We have had a massive boom. We can't carry on going up the rates forever. It is expected that we will have a slowdown at some point. When that will be, or as we've just shown there, no one can predict, but it would suggest that it is coming up. Now, what is priced in here is a slowdown. We've already had a slowdown priced into Barrett Development. And when you look at that, I don't think we're going to have that slowdown. I think, okay, we might have housing stagnant a little bit on house price growth. We might have a little bit of a decline. We may have the demand just come down a little bit, but it's still going to be really strong. And when you look at the 40% drop off, I think that's way too much. When you look at where we are in the UK on housing, we're still too short. You can see here that people expect that we need to be building 340,000 houses a year. Last year we grew 243,000. We're still at nearly 100,000 a year short on housing. So unfortunately, as much as people think there's going to be a slowdown, because there's so many people wanting houses, it's naturally going to still be really strong in the UK because we're so bad at building them, and that's what creates the demand. So sure, I think there might be a bit of a slowdown in the housing market. 100%, that's fine. I don't think it's a 40% dip. Maybe 10%, maybe 20% in the share price. I think this is a massive overreaction, so I'm buying a bit of Barrett Developments here because I still think the housing market will be strong in the future. And the recent earnings as well were pretty strong as well. The only reason why they were a little bit declined, if you look on the revenue basis, is because they're going off tough comps from last year. Because obviously in the first part of last year, everyone kind of stopped because of the CV situation, and then afterwards everyone went, oh right, everyone go back to work and start building up the houses, and there were massive amounts of completions in the back end of the year. So that's the only reason why there's a little bit of a slump on that point of view. But apart from that, when you look at the Reservations, it's still up on where we were previously, so there's no slowdown, as you can see here in the recent trading updates from Barrett Development. Like I said, valuation, I think it's quite cheap. Track record, it's got a good track record of growing that profit and revenue, apart from obviously the CV situation that you have here. Don't get me wrong, it's not going to be a massive grower, but it will have, I think, some share price appreciation at this sort of valuation, and I think I'll collect a nice dividend yield. Financial health-wise, it's solid. It's only got 3% debt to equity, as you can see here. A little bit of a bonus. There's been a lot of insiders buying recently, which is obviously a really positive sign, as you can see here. So happy with that. So yeah, that's Barrett Development. Next one, S4 Capital. So let me just check a second. Yes, the only pure growth play on this list, and I think it's a fantastic company. Obviously in the digital marketing space, people once again worried, okay, companies, if they're entering a slowdown, recession, what's they going to cut? Marketing budgets. And S4 Capital has been affected by that. Probably way too much in my opinion. You see here from September 2021, the stock is down 75%. And if you look at when this IPO'd, basically, yeah, it's not really had much appreciation at all, and that's when you consider like the financial performance of this company has been really strong. Even in the recent earnings report, reported revenue was up 70%, reported gross profit was up 64%, which is fantastic. Look at the past performance of the company, it's absolutely phenomenal. They are losing a little bit more money this year as they reinvest into the company in a couple of acquisitions and a few other issues that they've had to sort out, but that will sort itself out in the future. They will go back to this kind of break-even kind of numbers that they always keep trying to do and focus on that revenue growth. And when they want to focus on the profit growth, that will happen, because if you look at the gross margins, if I can just find them for you very quickly, they are currently at 81%, which is absolutely fantastic gross margins. At one-time sales, it's just insane to see a company that's probably going to grow like 30-40% a year at one-time sales. And eventually, when they carry on growing at this sort of rate, we're going to talk about a company that does over 1 billion in the next 12 months. When they do over 1 billion, they start ramping that profit margin up. You start getting 10% profit margins, 20% profit margins. At this sort of valuation, start running the 20% profit margins on a 1 billion revenue growth company valued at 1 billion, growing at 35%. Unbelievable upside. Like I said, I think this is at these sort of valuations. I mean, I don't like saying it too much, but I'm easily expecting a 5x return from here. And that would probably be actually minimum as well, to be honest with you. Ownership wise, there's been a lot of buying as well going on as well, which is positive, and it's also a founder led company as well, which is absolutely fantastic. So that's number 4. Number 5, last one. Of course, it had to make it on this list. One stock that I should have bought a lot more of a long time ago, which is Hollywood Bowl. Could easily make this my largest position in my portfolio. Same again, it's got the combination of a very good valuation, it pays a dividend, it also has a good amounts of growth as well. And at the moment, this stock is falling off a cliff. It's currently down 28%, as you can see here from April time. Or if we go from January time, it's actually down 30%. And it's very close to 52 close, as you can see, which is just unbelievable, because when you look at the financial performance of this company, unbelievably good. 8 times earnings, ridiculous. Same again, this should be like probably, I would say 15 to 20 times earnings. Dividend yield is down at 1%, 1.5%. This is actually incorrect. If I actually just jump across to Simple Wall Street, it's actually 3%. Google are a bit slow to update the full year dividend because they've only paid half it out at the moment. So yeah, it's actually a 3% dividend yield, which is fantastic. Obviously a bowling alley, but as well as having a bowling alley, very good locations. Even if you don't go for a bowling game, they're near restaurants, cinemas, so people can go to the arcades they have, they can go to the bars they have, the restaurants they have. So yeah, the combinations of the locations and all free incomes, also the mini golf they have as well, which I should not forget, is really good as well. The main acquisition to expand into Canada, so that should be where the growth is in the next 5 years. Look at the recent earnings, 36% revenue growth, gross profit was up 52%, ordinary dividend was up 32% as well. So the numbers are just absolutely smashing it out of the park. Like I said, valuation is just, I think it's just stupid in my opinion. If you look at the past performance, obviously you got the CV dip situation here, but just look at the lovely tick up in that revenue growth and that profit growth, and you see where they are now on the other side of the CV situation. And the company is, from where they were pre-CV, 20 million profit, 132 million in revenue. They're now at 161 million in revenue and 40 million in profit. So yeah, the profit has doubled over that CV situation, which is great. So yeah, I mean, how much more do you want of a company absolutely performing? Financial health wise, it's strong as well. It's recently paid off its debt as well, which is great because obviously it's making good amounts of money. It's got 49 million on cash, which is really good, or 50 million in cash, which is very good for a 335 million market cap company. Obviously, that cash balance is now going to be used for acquisitions and obviously paying down dividends, so it is going to get returned towards shareholders. And on the ownership wise, there has been a little bit of insider buying, which I guess is a really positive as well. And yeah, overall, 8 times earnings, 3% dividend yield, probably will grow a good, couple of percent a year as well. I think this is a fantastic opportunity, especially when the Canadian acquisition that they made for the bowling centres starts getting into play as well. I think it's really exciting. So those are the 5 UK stocks that I'm going to buy in July 2022. Hope you enjoyed it. Let me know what you think of them 5 stocks as well in the comment section, as always. And yeah, thanks for watching, and I'll catch you in a bit.